Frequently asked questions. The pros and cons of 1031 exchanges. In this segment, we want to look at some of the advantages and the pros of 1031 exchanges, and then also look at some of the disadvantages or some of the cons of 1031 exchanges. So on this slide, I'll cover some of the advantages of doing a Section 1031 exchange. The first one is fairly obvious. A 1031 exchange allows a taxpayer to obtain tax deferral. So they can defer taxes. They can defer the depreciation recapture, the federal capital gain taxes, the state taxes, and the net investment income tax if it's applicable under Section 1411. The second advantage of an exchange is wealth accumulation, preserving the equity. So as somebody does a 1031 exchange, they redeploy that equity into what they anticipate will be a better performing replacement property. So in a perfect world where investments tend to go up over the long term, that gives a taxpayer a chance to grow their equity, to preserve it, redeploy it, and to continue getting better returns on investments. So it might be obtaining larger properties or properties with more cash flow or other desirable aspects. Third benefit is leverage. So an investor can take a property that is free and clear, all paid for, and they can go ahead then and leverage that into a larger replacement property or multiple replacement properties where they go ahead and add some debt financing, say add some debt and mortgages to obtain a better return on investment. Fourth aspect is diversification. Now, a taxpayer can diversify by two ways. One is to diversify by the asset class, the type. So if somebody owns bare land, they might want to exchange into single-family rentals. They can exchange into industrial property, into office property, into retail, shopping center. So one way to diversify is by the type of property. It's held by investment, but maybe into a different segment. Another form of diversification is geographic diversification. In general, 1031 exchanges apply to property within the United States. And some investors that own a number of properties in one area might want to take advantage of a Section 1031 exchange, sell one asset, and acquire properties, replacement properties, in different areas. And that could be within the same state, or maybe they want to go out of state. And in that manner, from a long-term perspective, they don't have all of their eggs in one basket, so to speak. They provided some diversification. So if one part of the economy softens, they may have real estate and investments in other parts that are performing well. So a lot of investors seek to do that. Next, there is the potential to post-exchange. So after the 1031 exchange is over and the investor has closed on the purchase of a replacement property, they have the potential to potentially come back in at a later point in time and potentially refinance that replacement property and pull cash out of that property. The recommendation there is to make sure that this is done well after the purchase is old and cold. So certainly this would not happen anywhere during the 1031 exchange transaction. It's after the replacement property is closed and at a later point in time that the taxpayer could come back and pursue this alternative. Management relief is another opportunity. Many taxpayers might own multiple smaller properties. Maybe they've got a number of single-family rentals around town, and there are a lot of management responsibilities running around and keeping up with the management of the properties. That investor may want to exchange out of multiple relinquished properties into one larger replacement property. Maybe they exchange into one apartment where they've got an on-site manager who takes on some of those responsibilities. But maybe they at least put it into one location so they're not driving to different areas and spending a lot of time there, but they go ahead and put that into one location. So it could be for their benefit, or they can hire an on-site property manager to go ahead and handle the management. Estate planning is something that can apply to taxpayers that maybe have one large real estate holding with significant gain, and maybe they've got a number of children or multiple heirs. Some of those taxpayers might opt to do a 1031 exchange out of one asset today and exchange into multiple replacement properties so they can designate each one of those replacement properties goes to a separate heir down the road. So that's a kind of a way to reallocate while they're alive and optimize maybe how the assets are held for their heirs at a later point in time. And finally, taxpayers do get a step up in basis to fair market value on property that's inherited. So that's another advantage to be aware of. Now, there's some disadvantages of doing a 1031 exchange, or we call cons of exchanges. First off, it's fairly obvious the taxpayer must follow specific IRS rules and specific time restrictions. This is probably one of the bigger challenges. The taxpayers are subject to certain identification and exchange period rules. These are statutory, so the real estate market goes up and down, and yet the rules are constant. So in a market where there's very little inventory, where properties are turning over quickly, it may be much more challenging to identify properties and to close on them because properties are being picked up quickly by other investors. And the code doesn't allow for any variances or changes due to the real estate markets. So this is a challenge that many investors face. Another one is a lack of liquidity. 1031 exchanges are limited to like-kind property. So it's got to be with real property, another investment property. You can't exchange into or out of, let's say, a primary residence. So there are some restrictions there. With personal property exchanges, and we'll get into this in more detail in a later segment, the rules are also much more narrow and specific. The taxpayer has to acquire like class personal property or property within the same North American Standard Industrial Classification codes. So exchange an aircraft has to be exchanged for another aircraft, very narrowly. Another disadvantage is that the basis in the replacement property is lower than if the taxpayer purchased it outside of an exchange. So the replacement property basis, the simple formula is it's the purchase price minus the deferred gain. So what you want to be aware of is that the basis of the property given up gets transferred into the basis of the property being acquired. Now the next bullet point kind of flushes this out in more detail. Because the basis is lower, the taxpayer really has less depreciation available to them. So in doing an exchange, you forego increased depreciation that might otherwise be available to you today for the benefit of a tax-deferred exchange. So if you bought a property, you were able to depreciate the full property, or at least the improvement component of it. When you do an exchange, because that old basis is carried over, you don't have as much of that depreciation that's available to you. Another risk, and it's a real risk, is the risk of higher tax rates in the future. Nobody knows what the tax code looks like down the road, although many people suspect that we might be facing higher tax rates because we've got increased demands in different areas for tax revenue. So that certainly is a risk. The taxes are deferred. So remember I mentioned this in an earlier segment. This is considered non-recognition treatment. So the taxes are not recognized in this tax year. It's not a tax-free exchange. The relinquished property has a basis and that gets rolled over into the replacement property. So the taxes are merely deferred. And then finally, the capital gain taxes are going to need to be paid eventually when the property is sold in a taxable disposition. So you're just postponing that. So a 1031 exchange is really a timing mechanism. The taxes do eventually get paid. They're paid down the road. To review your specific 1031 exchange situation, contact Asset Preservation's headquarters in California at 800-282-1031 or our Eastern Regional Office in New York at 866-394-1031. Please read the full disclaimer, as Asset Preservation cannot provide tax or legal advice.